Коллеги,
Good afternoon, colleagues. We're happy to welcome you to the Bank of Russia. We're now starting the news conference by the Central Bank Governor Elvira Nabiullina. She'll first make an opening statement and follow up to Board of Directors meeting. Good day. Today, Bank of Russia Board of Directors reduced the key rate by 25 basis points to 7.25% per annum. The level of the key rate is gradually approaching the range that we denoted as neutral. This is the range where monetary policy does not encourage either reduction or acceleration in inflation relative to a target level. Let me remind you that now we evaluate the key rate to be at 6 to 7%, but we yet have to grope for a future level of the key rate to a point where we can say that the rate cut cycle is over. In the first place, we will look into how demand, credit, inflation, and the economy in general respond to rate reductions that we have already implemented. We admit that there's still potential for further reduction in the key rate. We expect to complete our transition to this neutral policy before the end of the year. That said, our estimate of the range of the neutral rate may change in the future, subject to a number of factors. I would like to make another point. Previously, as we discussed the neutral key rate, our assumption was that the money market rates would be very close to the key rate. At the moment, we're currently seeing that the banking sector is adjusting to the strong growing liquidity surplus. And even though money market rates remain within the corridor borders, they're lower than the key rate. This has some impact on monetary conditions. The situation is likely to remain for some time. We take this into account as we make our key rate decisions. We'll also seek to bring money market rates closer to the key rate, but only using those measures that would not constrain interbank credit. Now let me say a few words about our vision of the current situation and our forecasts. I will highlight the key reasons behind our today's decision. First, we note the systemic character of inflation movement towards all-time low readings. This is evidenced by price trends across various products and regions. Prices for most consumer goods and services are growing at least in 4% in annual terms. Roughly 2/3 in consumer goods and services in December and 3/4 in February. In regional breakdown, inflation in February totaled under 4% in all but one of regions of Russia. Second, we have reviewed somewhat the nature of factors that drive inflation movement. Recent trends in the food markets were considered to have been mainly triggered by temporary tailwinds, primarily weather conditions. However, the moderate growth of food prices has held longer, much longer than we anticipated. We believe this is the result of investments into agriculture, which boosted its production potential. We certainly do take into account the fact that food prices will likely remain more volatile than other product groups. However, as new technologies will be implemented in agriculture, this will undermine the dependence of agricultural produce and respectively of price movements on the weather conditions. This is no less than a structural change, and it will have long-lasting effects. Similarly, the budget rule, the fiscal rule, has reduced significantly the impact of oil market fluctuations on domestic economic conditions. As we're seeing, ruble exchange rate has become less sensitive to oil prices. We note that the scale of this impact on a wide range of consumer prices has declined. Third, we took into account inflation expectations of our population, this business community. Inflation expectations are going down among these households. As regards expectations of market players, they've been steadily around 4% for quite long. We now observe a profound shift in inflation expectations of the business community. Our surveys show that about 60% out of 680 respondents polled by the Bank of Russia have embedded 4% or less inflation is their business plans. 1 year ago it was only 22% out of 1,300 of poll participants. However, household inflation expectations are still heightened and sensitive to temporary upticks in prices for separate groups of products, and this may generate pro-inflationary risks. We also note propensity to consume is rising gradually. Overall, demand, meanwhile, brings about no major risks of inflation deviating upwards from 4%. This said, we do see strengthening potential in this risk related to the situation in the labor market, but I'll talk about it later. As to influence of other factors on inflation, including the exchange rate, rates of indexation of regulated tariffs and prices, movement in global commodity prices was minor. The total impact was close to neutral. As regards further dynamics of inflation, we expect that in the second quarter it will hit the new low. This will be driven by the past year high base effect in the food segment. After that, annual inflation will progressively return to 4%. This will be facilitated by rising consumer demand amid monetary policy easing. According to our forecast, inflation may stand at 3 to 4% as of this year end. It will hold near 4% in 2019. As regards inflation risks, the Bank of Russia left its estimates overall unchanged. However, the effect of some factors will demand some of our attention. Such factors include, among others, the growth of productivity of labor lagging behind wage and income movements. At the beginning of the year, incomes showed substantial growth. They're still largely uncertain whether this delay is one-off phenomena or will a sustainable trend emerge on the backdrop of expanding skill shortage in the labor market. As fresh data is released, will track the impact of this factor on consumer demand and estimate the possible pro-inflationary effect. Naturally, oil and food price dynamics at large continues to remain source of uncertainty. As I've mentioned, they're losing their grip on inflation. Nevertheless, their considerable fluctuation may have tangible effect on core inflation. The balance of risks will also depend on those fiscal and rate decisions that will be made this year and beyond. Risks associated with the global market situation are also on the rise, given the high growth rates and low unemployment. Monetary policy in the EU and Eurozone area may normalize faster than market participants currently expect. The revision of market expectations may come along with volatility surges, as we've seen this February. Furthermore, policy normalization will bring term and risk premium revisions and a likely upward revision of neutral interest rates abroad. This may discourage investment in emerging market assets, including Russia's. We're also concerned by increased protectionism in world trade due to its potential impact on the growth of the global economy. As for our midterm forecast, we slightly adjusted oil price assumption. In December, we expected average annual prices to hold at 55, 45, 42. In 2018, 2020, now we expect them to be at 61, 55, 50. Nevertheless, this oil price revision does not change our overall conservative expectation. This oil price revision in the context of the budget will hardly change our expectation as regards GDP growth and other economic activity indicators. Changes in the balance of payment were a little more tangible. The forecast for the current account balance was revised from 43 billion to 59 billion in 2018. Russia is expected to remain net exporter over the entire forecast horizon. We revised our forecast of capital outflow, which is expected to increase from 16 billion to 19 billion, while reserves will rise by 50 billion instead of 33 billion as previously expected. Let me once again remind you that capital outflow does not mean Those transactions flow in the current and capital accounts mirror each other. As all revenues grow, it is recorded both as current account inflow and capital outflow if it's stored in foreign currency, for instance. As regards economic growth, the baseline scenario suggests that it will hold between 1.52% on the entire forecast horizon. January and February economic development data confirmed our estimates that the slowdown in GDP growth at the end of last year was of temporary nature. At the beginning of the year, the economy continued to expand. As I've already mentioned, we intend to complete the transition to neutral monetary policy in 2018. What will happen after it is neutral? This will mean that we have completed the rate cut cycle, and after that, key rate may be revised both up and down depending on inflation dynamics, economic activity, and their forecast readings. Should inflation stabilize near 4% and the economy grow at the rate close to its potential, the key rate may be kept unchanged for a long time. To conclude, I would like to stress that the transition to sustainably low inflation is a structural shift. Sustainably low inflation reduces uncertainty for business and is very important for household welfare. Furthermore, low inflation sets new roles of business conduct, and as it encourages higher effectiveness and search for new competitive advantages. Ultimately, all of those should boost high quality and sustainable economic growth in our country. Thank you, and I'm ready to take your questions. We move on to the Q&A session. I would like to remind you to introduce yourselves and name the media you're representing. Bloomberg, Olga Tanas. Could you please clarify about the neutral rate? You said that as soon as the key rate reaches a neutral level, you will complete the easing cycle, and then key rate could be revised both upwards and downwards. What is this level? At the moment, neutral rate stands at 6 to 7%. So when is the threshold? And second question, since you revised your inflation forecast to 3 and 4% this year, will it be possible to revise downwards the neutral rate from 6.7 to 5.6? And if yes, then when is it likely to happen? Thank you for this question. There is a reason why we always indicate a range. We don't give a figure of a neutral rate. We give a range, 6 to 7%. And we really need to find this level at which this key rate, money market rate, would not either accelerate or decelerate inflation. It can only be done by trial. 6 to 7% is based on estimate, and this range can change. You've probably seen that many countries revise the level of neutral rate depending on the domestic conditions. For instance, recently US first reduced and then revised upwards their assessment of the neutral rate. So what do we look at? We'll look at the real foreign rate, we'll look at our inflation, the target inflation, and the country risk premium. The country risk premium may vary. The level of foreign rate does as well, and it can lead to changes of how we estimate this neutral corridor. As to when is this likely to happen, we don't know, but it is possible. The fact that inflation is now below 4% gives us an opportunity to reduce rates faster than we originally anticipated. This will mean that we'll reach the neutral level sooner than we anticipated. But that said, we understand that gradually inflation, as of the second half of this year, will start approaching 4%. Thus, we intend to gradually change the rate, and at some moment in time during this year, depending on the situation, will complete the shift towards the neutral rate. And I often hear this question, when is this likely to happen exactly? That will depend on many factors, but our forecast is that we plan to shift towards neutral rate before this year end. Tatiana? Tatiana Lamskaya, Vedomosti. The president, as a result of his State of the Nation address, tasked you, among others, to prepare proposals that would help to boost investment at 25% by the year 2024. And he also noted that he counts on close cooperation between government and central bank in ensuring investment growth and economic growth. What is it specifically that the central bank is expected to do? What steps, what measures, and what suggestions are you expected to give? Well, I can tell you about what suggestions we're working on and our contribution, as we see it, to boosting investment and attracting more investment to the country. If we want to achieve sustainable economic growth, if we want to achieve higher competitiveness, we need to attract investment. First, we believe that through our monetary policy, through the reduction of inflation, we improve the business climate in this country, because business community can plan for a longer horizon. This changes the model of operation of the business community, and it cannot shift its going cost into prices, and it has to look for new ways to be competitive through attracting investments, through boosting productivity. This is the first area that's related to the monetary policy. As for our cooperation with government, we act as mega regulator because we're responsible for the development of financial market, for creating more long money in this country. This is one of our priorities. Low inflation is one of the preconditions, but not a sufficient condition to create long money. We need to attract institutional investors that would be interested in the long money, and that means all the steps related to the pension savings, and we're promoting this idea and concept of individual pension capital that would help open up new investment opportunities in the country. Not just pension savings, but also strengthening of non-state pension funds. We're doing stress tests for them that would help boost confidence in those non-public private pension funds, and that would create another resource for investment. Life insurance, bond market development, including infrastructure, securities, all of that, in our view, will create conducive environment for investments. It's also obvious, and I mentioned that in my previous statement, we will adjust banking regulation. We're going to introduce the stimulating approach that will help motivate banks to invest in the real economy and finance investment projects. But we'll make sure that all risks are taken into account, and we'll take individual approach, case-by-case basis. We're discussing it with the banking community, so we're working on a set of proposals. It's going to be a broad range of activities, and I think it's very important not just to talk about debt financing and investing in the credit, but also attracting capital investment. This is what we lack in this country, and we need to create an environment that would be conducive for projects that would allow to attract equity capital, that would help achieve transparency. So it's a comprehensive task, and we're ready to discuss with the government the role we could play in this exercise. Elena? Elena Fabrichная, Reuters, could you please assess how your financial recovery efforts of the recent recovery will influence on the inflation? They recently were given another billion. How do they invest? Will it influence the inflation? Well, this liquidity injection will have no impact on inflation. As you see, our inflation remains below 4%, but it's obvious that the money that is allocated for the financial recovery, for the bailout, will increase the structural surplus of the liquidity. We see that, but we know how to deal with it. We know how to deal with the structural surplus of the liquidity, and we take that into account as we decide on as we make decisions on the key rate. Alexandra. Russia 24, Alexandra Suvorova. Question about mortgage. Is it likely that mortgage rate will go down to 6-7%, not just to a select group of individuals, but to all citizens? Well, we're seeing good pace of growth of the mortgage. We are very interested in seeing high-quality mortgage loans, so therefore regulation is structured to encourage high-quality mortgage loans, making sure that lenders are able to service their debt. As regards rate reduction, it is already happening, and it will continue happening gradually. Nonetheless, this rate will probably be higher than our key rate. The range of the key rate, like I said, is going to be 6 to 7%. So most likely the mortgage rate will be higher. It could be lower for special subsidized programs that are in place in various regions for different groups of people. Nonetheless, access to mortgage will be eased, and it's largely due to the decrease in inflation, because as inflation goes down, long-term loans become more attractive, and mortgage rates go up once people are confident that inflation is under control. More questions? Staleva Anastasia Interfax. You mentioned in your statement that the growth in mortgage and consumer loans does not entail risks that inflation would go beyond 4%. At what point could we say that the growth of loans and lending in mortgage and consumer could risk inflation and financial stability? You probably remember that we said some time ago, as we decided to cool down the fast-growing consumer lending market back in 2014, we said that the growth rate should be close to the rate of growth of nominal wages of the population. This is not a direct correlation, because at some point the income level dropped, and then we saw the recovery both of wages and lending. So we're tracking all factors that have impact, both related with financial risks, level of debt burden, because we still haven't reached pre-crisis level of debt burden. Although it's growing fast, still the level of indebtedness remains lower than before the crisis. Nonetheless, we think that those loans, including mortgage and consumer loans, should grow at fast rate as the economy is recovering, but we're keeping close eye on them, and we consider raising a risk coefficient, for instance, for unsecured loans. Dmitry Pachenko, Kommersant. For the past 18 months, we've heard you mention during the future meetings of the Board of Governance, but you didn't explain this time what will happen at the next meeting. I understand there are no obvious factors that could prompt you to reduce rate. Inflation expectations are unlikely to drop. Inflation is likely to stay more or less the same. How are you going to explain your decision at the future meetings? You're right, indeed. Some time ago, we did send messages about what to expect at the future meetings, but we decided not to do so because it became evident for the market that we're in that cycle, and now it's apparent that we can change the rate upwards or downwards by 0.5, just like this time, or even pause. We have not completed the reduction cycle yet. Once we do, after we reach this 6 to 7 range, and we will not know once we've crossed the 7% threshold, because we will see how the inflation changes, what risks exist, inflation, disinflation risks. So we'll need to see what impact our decisions have, whether. So there is no any specific trigger, but will very much be dependent on what is happening in the economy. As to inflation expectations, we think that there's great potential for the reduction of pro-inflationary expectation of the population. By the way, when we took a decision in February, initially we got the data. It's initially at 8.9, then it dropped to 8.4. Now it stands at 8.5. So as you can see, there are fluctuations, but we think there is some potential for the inflation expectations of the population to further reduce. Mila Kuznichan, RIA Novosti. Early this year, the Ministry of Economic Development noted the slowdown of economic growth in February. Their assessment was 1.4%. How do you explain this slowdown? Do you expect it to continue by the end of first quarter and in the second quarter? You also mentioned that inflation will be at the minimum level in the second quarter. Could you please clarify what is minimum? We think that the economic growth as the economic growth continues, it cannot be, the pace of growth cannot be continuous. It will slow down and speed up. By the way, GDP monthly data is not the most reliable source of information, so it's better to base your assumptions on quarterly data, not on monthly data. We see all signs of continuing growth, large base in many sectors, many areas. That said, we are approaching the potential growth rate, which in our view, and according to our estimate, stands at 1.52%. We count very much on structural reform that would help lift our forecast. But at this moment, we use the conservative approach for our forecasts, depending on the current structural situation, and we assess growth rate to be 1.52%. As regards second quarter, we think that inflation could stay at about 2%. This is due to the base of the last year. Last year, the consumer food prices growth was significant. Seasonality shifted, and this will have impact on annual numbers for the second quarter of this year. Anton Feinberg, Arbeka. Vladimir Putin, in his State of the Nation address, announced new measures to reduce poverty twofold, increase spending on medicine, education, infrastructure. In 2018 already, new payments will be made to stimulate birth rate, and salaries for civil servants and people employed by the state will be increased. Is it likely to boost inflation and accelerate return to the 4%? Well, the targets that were indicated will require additional spending from the budget for healthcare, education, infrastructure. I think that if it is coupled by structural reform, and if the growth rate is higher than the potential that we see at the moment, it will create additional revenue base, and we also need to increase efficiency of budget spendings, and all of that, if it happens, will result in no risks in terms of inflation and the macroeconomic stability. In general, this is our basic assumption. Those spendings are needed for the economy, but as regards any specifics, all the amounts and timelines, well, we'll take that into consideration as we get more certainty, and we'll consider it when deciding on the key rate. We have a toolkit, in any case, to make sure that our monetary policy allows us to keep the average inflation level close to 4%. Piotr Arechin, Gazeta.ru. Can you please specify? You mentioned participation in the investment policy in line with the task set by the president. Does that mean that central bank will not participate in project finance or refinancing programs like the one that was implemented back in 2016 when the Central Bank of Russia granted about 90 billion as funding? And my second question is, should inflation stay at this level, where we're seeing it now, 2.5%, will the central bank be satisfied, or will it be affected, will restrain the growth of the economy? Thank you very much for those questions. As for our engagement in investment, as regards project finance, we do participate as a regulator. We decided that those projects that are done through the National Economic Bank will have a special approach when it comes to provisioning, because we understand that these are serious companies, not shell companies, and we're ready to roll out this approach not just to projects that happen under the aegis of the VEB, but on others. As regards special refinancing instruments, when central banks in the past allocated liquidity for various projects, we did take such decisions in various sectors in the midst of the economic crisis, where we had to significantly raise rates to support priority sectors as the markets dropped. In September 2017, the board of directors decided to withdraw from those instruments and drafted a strategy. This withdrawal will be gradual. Initially, we decided not to raise thresholds, and we're not doing it any longer. And then we'll gradually phase out those measures as the money is repaid. It will take, on average, 3 years, a little longer for the project finance. We're not going to change our policy. We believe that as the inflation goes down, we will be reducing our rates. General rates in the economy will also be reduced, and lending becomes more affordable for a broad range of economic agents. And if there's need to support priority areas, this should be done through government programs. As for your second question regarding the level of inflation, if it stays at 2.5% long, we don't see that it's likely to remain at 2.5%. We believe that as of the second half of this year, it will start returning to 4%. We don't think, that said, that our rate is limiting the economic growth. We see that the economic growth is recovering. It's very close to its potential. The pace of economic growth is limited by structural factors, we believe. But what if it stays at 2.5%? Will the central bank be okay with that? I think it's good that now it stands below 4%, because it offers us an opportunity to reduce inflation expectations that are highly dependent on inflation, especially at the initial stage when we just started inflation targeting. And second, it gives us an opportunity to reduce key rate and bring it closer to neutral even faster than we expected. Nonetheless, that said, should it stay at 2.5% too long, we'll take steps to bring it closer to 4%. Even if we have to move from neutral to accommodative, we will probably do that. We promise that in the midterm the rate will be about 4%. We understand there will be fluctuations, but we'll need to attain this goal through monetary policy instruments. Margarita. Anatoly Gennadievich suggested to unite all bank associations in one. Would the central bank support this proposal? Well, it will be up to the bank community. We're ready to support any decision they may take. We're ready to work with one or many associations. It's completely up to them to decide. Olga. Olga Tanas, Bloomberg. Could you please clarify, since inflation is expected to be at 3 to 4%, does that mean that central bank is likely to return to the FX market to replenish its reserves, since inflation is stabilized and you don't see risks in terms of financial stability? And the second question, you mentioned protectionism. Could you elaborate, since Trump did sign the document that introduces tariffs against China? China's already responded that it will respond by taking certain steps. Do you see any risks of trade war that many analysts see, and what would that mean for the Russian economy? Our FX and gold reserves are being replenished because the fiscal rule is in place. According to our estimates, we will, without making any additional interventions, we will achieve 500 billion. That was our target. So we're not planning to do any additional purchases at this moment in time. As regards protectionism, we do see growing risks of protectionism, and there's growing uncertainty. No one can say whether the spiral of protectionism is going to be unwinding or is it going to stop at some point in time, but it's obvious that protectionism, should it be escalating, will create risks for the world trade and the global economic growth. We are an open country. We have a large share of foreign trade into GDP, and it will definitely impact us. The measures that have been taken, the direct impact on Russia's economy will be very limited. It will not impact our major indicator, but should risks grow, it can indirectly impact Russia to the general situation of the global economy. So this will be an unwelcome scenario. Dmitry, do you agree that in January already the unemployment rate was below the equilibrium rate? How will this trend develop in the future, and are you planning to influence that? Well, talking about the equilibrium rate of unemployment, it's very difficult to assess it. It's just as difficult as every time we talk about any equilibrium rate. I think we're approaching it, because 4.8, adjusted by seasonality, is a rather low level of unemployment, and in certain markets, in certain regions already now, we're seeing signs of deficit. But this could be the result of the demographic situation in this country. It can impact the assessment of equilibrium rate of unemployment, can reduce it. Whether we're willing to influence that or not, I think we can only do that through structural change, raise in productivity, etc. But we do take that into account, and we're very closely following the situation in the labor market and the productivity and how that impacts the growth of the economy and pro-inflationary risks. Sasha? In the follow-up of the long money, what mechanisms does the central bank have? What do you have to bring more long money in the economy? Let me repeat that our main instrument is reducing inflation, because it makes the money longer, creates preconditions for that. We don't have very many independent tools. What we can do is make financial institutions more sustainable. By financial institutions, I mean insurance companies or pension funds, build confidence of the general public, and encourage them to invest their money for the long run in those institutions. And this in itself will create long money. Partly the problem is linked to legislation and legal framework, and we have to deal with government and create the concept of long-term pension savings. Pension savings used to be frozen, but I think pension savings are needed to increase living standards of the pension holders, and also it's an important tool that helps create long money in the economy. In addition to what I've already mentioned, pension fund money, insurance company money, collective investment is also a very promising instrument that needs to be developed. Their share remains very limited, and we're trying to fine-tune regulation because we see many barriers. And as you list them, they all seem merely technical, but if put together, they impact the development of collective investment. That is another instrument to create long money needed for the economy. We're running out of time, colleagues. Last question, Andrei. Andreas Strauch-Reuters. I have one big question about the key rate, but I would split it into two. My first sub-question is, how do you see inflation risks from the higher than expected growth of wages in February? According to our forecast, it was supposed to grow by 6%, but in reality it grew by 10%. My second question has to do with timing. We're all trying to figure out when will the next decrease happen? Will the next reduction of the rate happen? Is it likely that you will first look at the yield of crops? Thank you for those questions. Indeed, the significant growth of real wages happened early this year, and real income population moved into the positive. Well, let's see if this trend continues, because wages grew not just for state-employed people, but in the private sector as well. The structure is different, so it's not quite clear to us as to what will the trend be in the future. We'll monitor the situation. We don't see any major risks, but we will closely monitor the situation as regards to our future steps. On the key rate, like I said, we think that there's still potential for further reduction. But as we analyze combined risks, we take our decision. Crop yield is no longer on the top lines. In the past, early every year would think a lot about the crop yield, but the recent 2 years have shown that the volatility and its impact on prices has been decreasing significantly. Therefore, we no longer think it's a limiting factor. But talking about the rate, I would like to draw your attention to the fact that as we take our decisions, we will be very gradual. This is a main principle. It's very important that market participants, business community, base their plans, their business models with account to our rate movement and inflation movement. And they very much count on the smoothness and predictability, and will try to stick to those principles. But again, let me stress that it is not impossible that we will stop at some point, that will revise it upwards or downwards by 0.25%. Thank you very much, colleagues. Thank you for very interesting questions. With this, we conclude.